This is the Definitely Uncertain podcast. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome everyone, I'm Darren Rockman, a partner at Goldrock Capital. Today I am excited to welcome onto the podcast Mark DeNatale on the line from New York. How are you, Mark?
Darren, doing great. Thank you for having me today.
Terrific. Thank you for joining. So Mark is a partner at CVC Credit Partners, and in fact, he heads up the Global Special Situations Group there, and that's another way of saying that he invests in stressed and distressed companies, and he's responsible for over $4 billion in assets. So Mark, I think it's probably right to say that your business thrives on uncertainty and your ability to navigate that uncertainty, which probably makes you the very best person I could think of to have on the Definitely Uncertain podcast. So I think it's probably clear that we are globally in a recession. How much stress are you seeing today in corporates around the world?
Sure. I think, first off, you have to take a step back. I think, we are truly in the World Cup of credit selection across Europe and North America. Those are the arenas that my team and I focus on. And I think it's really a tale of two worlds. When you think about, if you just talk about investment grade, okay, it's getting significant support from the ECB and the central bank here in the States, and investment grade is up 3% plus year to date. But below the surface, Darren, there's significant dispersion. Okay, to give you a flavor of just how much stress there is, 20% of the credit market's been downgraded year to date. Okay, 20%. It's a big number. Yeah. And on top of that, the percentage of companies, there's a stat that Deutsche Bank came out with recently, the percentage of companies that have their debt service cost greater than their profit, okay, is hitting 20%. If you go back to the great financial crisis, that peaked at 8 to 10%. And against all this, right, we have an uncertain, to your comments, an uncertain GDP go forward, right? We had the ECB, come out and say, 2020 would be down 8%. And we have, in the Fed on the U.S. side down 6%. And I've heard the reference loved. Is it an L shape, a U shape, or a V shape into 2021?
Right. So 20% of those companies are having to effectively dip into their pocket to make sure that they can pay their debt and return whatever capital that they need to pay back to the bank or whoever they borrowed. So and that's, you've been doing this for a very long time. That's substantially worse than where we were after the last couple of recessions, 2000, 2008.
Without question. I think when I look at the credit markets today versus, operating, back in 2001, going back to, mentioning 2008, I would just highlight the degree of difficulty is much higher today. And to frame it, I think I always like to frame it when you think about 2001, 8 into today's cycle, you have to first start with rates, right? And when you think about 2001, you had a 10-year rate at about 5%.
Interest rates, yeah.
Right? Interest rates, right? The 10-year interest rate was about 5%. I think when you look at 2008, we're at about 3.25%.
Yeah.
Right? And today we're at a 0.6%. And so, in those previous cycles, right, you had that proverbial good company, bad balance sheet. Okay. Right. Today you have that, but you also have a much different rate environment, okay, that you're navigating. And that plays a big part in terms of how you think about working out these assets.
Right. That really, in some ways, should make it easier for companies to get through because they're just paying much lower rates on their loan.
It will. What it does do, Darren, I think it pushes off the inevitable.
Right.
Okay. And so that's the key. All right. I mean, they benefit today because they have low rates, right? We have 13 to 15 trillion of negative rates, across the globe. But the degree of difficulty that I mentioned, okay, is much higher because the inherent risks are much higher in the credit universe.
Right. And that's also, I assume, you've got to factor in the fact that the economy is in such trouble, which obviously makes those risks even higher in some way.
Without question. That's before we even get to the economy, right? I think our team right now, we've had this conversation historically with you and your team, and we're underwriting a small U in 2021. Okay, in the space we're focused on, as I tell the team, it's about free cash flow generation. How are we going to reposition this company to be on a sustainable path? The companies we're buying, they don't have access to the Fed. Okay, they have access to their own cash generation machine, and balanced around that, I think there's some really significant risks that we're navigating. You could be in a bankruptcy 15 years ago for 3 or 4 years, work the company out. Okay, but today, one, there's massive structural shifts happening in the industry. You might not have, this company might not have a 3-year runway.
Right. 2,
it's really expensive. We've seen some legal and financial fees on a bankruptcy hit 7% of total debt. The average number is 1%. That eats into your equity return.
Makes your job harder.
Makes it hard. So there are a number of calculuses that you have to get right, okay, in that process.
Right. I want to switch to something else for a second. Do you see there being, there's been this great return of the equity markets and of the bond markets, as you mentioned before, since the lows that we saw in March. You're dealing with both private and public. Do you see there as being a big disconnect now between what's happening in the public markets, as opposed to what's happening in private companies?
Without question. I mean, I would just use it by example, right? I mean, the investment grade landscape, okay, that's the public side, right? IG companies have access to the Fed. The Fed's been vocal about it, even just yesterday with the Fed announcement. IG's up 3%. Look at the Russell, right? The
small
Russell,
companies.
Small companies, the Russell 2000, it's down almost 20% year to date. And that mirrors CCC credit. CCC credit is down 16% year to date. And so that's the exciting part, though, to me.
Right.
Okay. All right. That's why we're in this World Cup of credit selection. Okay. Because there's not a lot of research on those private companies. Okay. So you have to have real infrastructure in terms of research and analysis. Okay. But if you can get an edge, okay, that's where the value create is. Okay. To drive returns outside of that 0.68, 10-year, quote unquote, risk-free rate.
Interesting. Now you're a high net worth investor and you've seen the types of distress that you're talking about and you want to try and take advantage of doing so, of that market and that situation. What would be your tip for an investor who wants to somehow enjoy navigating this world?
I would recommend what I do with my own personal capital. Okay, I look for teams that have a long history in the market. Okay, they're not transients. Okay? 2, they have a significant amount of their own capital aligned, okay, with the strategy.
Yeah.
Okay, and then 3rd, and this is important, are they putting capital at work? There's a number of public firms now in this space that are putting capital to work for the sake of hitting their quarterly earnings. And I think, if you can align that, okay, with a strategy that is locked up and has time to realize the value.
Because it's going to take time. This isn't going to be overnight.
The runway on working these assets when we underwrite them are between 18 and 36 months. Right. And so that would be the last piece. You have to make sure you are in a structure, okay, that gives you the opportunity to drive that risk-adjusted return that we often talk about.
Right. That you're not going to be, suddenly have the rug pulled out from under you because someone's pulling the capital away.
Exactly.
Yeah.
Exactly.
Okay, great. Well, Mark, that was fantastic. Thank you very much. Best of luck to you and your team as you navigate the markets and hopefully pick up some really great assets along the way. Thanks, everybody, for listening. This is the Definitely Uncertain podcast. And bye-bye, everybody. Thanks, Mark.
Have a great day, Darren. Thank you.